I have to
Yeah,
call it a speculative frenzy,
yeah.
because we're all seeing and hearing the same things. The plumbing is breaking apart. The plumbing is doesn't work. Volatility is going up. Prices are going up. Banks are quoting less size to each other for physical. The risk of something breaking is really close.
With gold now stabilizing around $5,000, will we head for another rally soon, or is this the top? We'll find out what's next for gold, precious metals, oil, and the entire commodity complex with Ole Hansen, head of commodity strategy at Saxo Bank. Welcome to the show, Ole. Good to see you.
Thank you very much, David. Thank you for having me.
Been a fan of your work for many years, so it's a pleasure to finally be able to host you and talk to you today. Let's start with your analysis on where we are currently in this commodity cycle. Now, you told me offline that we are perhaps starting the third commodity bull cycle since the 1970s, and I'd like to just pull up a chart to show you what that may or may not look like. So here we have, let me just switch this to gold. If you can take a look now, Oli, we are currently at $5,000. This would be, well, this is not, let's just take a longer term chart. This would be the third major cycle peak since 1980, then 2011, then now. And so if we want to discount 2020, because it's only been a couple of years and 2020 was not a huge rise relative to what we have now. Only if this is the third cycle, some would argue that we're already exhibiting the cycle top, as it's been stabilizing around 5,000. It's already corrected 20% in one day, which is exactly what happened in 2011 before it stabilized and then went down another 50% in the following year. Does this look similar to what's happening in 2012, Oli?
Well, first of all, clearly when you look at the chart, you can't help suffering a little bit of vertigo because that straight line up that
That's
we've
right.
seen now in the past few months would make anyone a little bit nervous and hesitant about getting involved, and I think that's probably where we are right now. I think the underlying reasons for holding gold are most certainly still relevant. They are still there. They are long term, and they are the reason why we're seeing investors moving towards the gold market. But at the same time, having run as fast as we have in a short period of time, there is an argument that we need to consolidate now and just basically see how where it takes us. I just put out on X earlier today, just a technical observation that I've watched for many years. If you go all the way back to 2005, every time gold has moved more than 20% away from its 200-day moving average, we have on several occasions in the last 20 years since seen the correction in gold, taking it back down to the 200-day moving average, or perhaps even overshooting to the downside. The move we saw last month took us more than 30% away from that average, and right now we're around 22. That could indicate to me that we're still a little bit overstretched from a technical basis, but from a longer term basis, I think gold is still most certainly worth valid to hold. So if someone asked me what to do at this point level, I'll just basically just take it easy. I would say I would not. If you hold gold, say, sit with it. If you are looking to get involved, just be a little bit patient here, see where it takes us, because it just show a little bit of signs that we may just need to see a longer or perhaps an even a deeper correction. But I see that as a healthy sign, because then we get this kind of vertical line out of the way.
What is Saxo Bank's view on gold, and what is your forecast, Oli? We have major banks in the U.S., for example, being very bullish. J.P. Morgan has updated its forecast now to $6,000 target in a special report earlier February for end of year 2026. So 5,000 is not even the end, according to them. What is your view?
No, I think that's it's not most certainly not the end. We had 5,500, but with the recent move where we actually basically all touched that level already, we had to take a relook. And with that in mind, I think 6,000 is within reach in the next 12 months. But it does obviously depend as well how deep the correction is going to be. If we're doing if we drop another $1,000 from here, then it will be a little bit harder stretch to reach within 12 months. But I think the reasons again for diversifying and looking at gold as a bit of a lottery ticket or a safe haven or insurance premium. It's not a lottery ticket. That's if you buy a $20,000 call, as I hear someone is buying right now in the gold market. That's a lottery ticket, but it's an insurance premium against something starting to crack elsewhere. And I think we got plenty of uncertainties in the world right now, both politically and economically, that warrants such cautiousness, and that's why the potential for breaking above the 5,500 again, reaching up towards 6,000, can most certainly not be ruled out.
Let's talk about these other cracks. The fact that gold has risen so fast, so quickly, silver as well, and then stabilized around current levels. Does that signal to you that there may be a little less uncertainty going forward? Perhaps there may be less volatility in the stock markets than a few months ago? We've already had major corrections in some of the Mag 7 stocks in the last 2 months, Ole.
Yeah, we're seeing a very aggressive rotation right now in the U.S. stock market, and I think once the dust settles, the market's probably run ahead of itself in terms of how much the AI rollout is going to mean to profitability and to jobs, and some of these companies, these tech companies' potential earnings going forward. So I think we've probably gone too far at this point, and there will be a realization. So we could see a rebound in the stock market, but at the same time, there's also rotation going on. We can see the Mag 7; they're basically flat on the year. They're only up 10% in the last year. So when you have such a significant sector or market cap that's not really performing, that basically means investors around the world who invest or automatically invest into a world index, they end up holding quite a lot of these Mag 7 stocks, and I think there's slowly realization that maybe some further diversification is needed. So we are seeing a rotation within the U.S. stock market. We're also seeing a rotation away from the U.S. stock market. We're seeing emerging markets doing very well. Some spots in Europe as well recovering, but generally the AI is, I think at this point in time, market is pricing in too much in terms of what impact it will have. It will have a major impact, but it's not going to happen overnight. And some of these stocks, basically, where the drops we've seen more or less reflect that something was going to impact them within the next 6 to 12 months. It's probably going to take longer than that.
Okay, what is the signal relative when it comes to inflation, Ole? So right now, inflation has been stabilizing again. The last CPI report from January in the U.S. showed inflation, headline inflation at 2.4%. year over year, slightly down from the previous month's 2.5%. And what does this mean for gold?
Well, it means first of all that the pressure from the White House to cut rates is probably an easier decision to make when we have price pressures easing. So the market is now once again looking for at least 2 cuts this year before October, and perhaps even on a good day pricing in 3 cuts before the end of the year. So that cut is back in focus, and ultimately before we started looking at all the other reasons why gold started to rally in 22, especially when central banks started to buy up, and they are not as interest rate sensitive as traditional investors were previously, and also before Chinese investors really jumped on board. We had the interest rates being a key driver for gold. That one is still there because there's no doubt that when the funding cost comes down and the cost of holding a non-coupon interest-paying asset comes down, then that does underlyingly benefit, and that also opens up the door for some types of investors who are faced with this carry, the negative carry, and probably up until the first rate cut started last year, were not able to invest into gold simply because the carry or the cost of holding was too high. And I think that's also one of the reasons why ETF demand only really starts to recover when interest rates started to get cut after inflation peaked.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. You already know why people hold gold, because it's real money. But what if your gold could do more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your gold works for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn a monthly yield in gold through Monetary Metals. So don't just hold it, put it to work. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and start earning real gold on your gold today. What about if the long end of the yield curve, so the 10-year or the 30-year continues to rise, Ole? So it's been, the 10-year has risen substantially since 2020. It's been stabilizing around 4%, 4.5% ever since the last couple of years. Ole, what does this mean for precious metals if yields continue to rise? Will that put downward pressure on the price as investors flock to fixed income products?
Well, if we go back 5 years, then the answer would definitely have been yes. Rising interest rates also further out the curve, meaning rising real yields is not has historically been bad for gold. But I think right now the market is viewing the long end of the curve as much as a focus on the U.S. On the outlook for the U.S. economy and the U.S. debt situation, and we've seen situation in the last 18 months where long end yields have been going up, but gold has been going up at the same time, simply because some of the reason why gold has been going up is the worry about the debt situation, and we're also seeing some divestments going on, or investors around the world divesting their holdings in treasuries. So so the fact that yields can go up and has been going up at certain points has been taken as a sign of increased risk in the government market, and with that in mind, if we do see a further rise in long end yields from here, even at a time where the short end yields will come down, so the curve is steepening, I think that will still be supportive for gold for those reasons, that it's taken as the market basically asking for a bigger insurance or a bigger risk premium to invest in the long end of the U.S. curve, simply because of the debt creation that we're currently seeing, and no signs that there's any political will to bring it under control from either side of the aisle of the Congress.
So who will be contributing to gold's rise to the next level? Will it be central banks primarily? Will it be investors from Asia or investors from Europe and North America?
I think all of them. The central bank demand may start to slow simply because the value of that gold portfolio has risen to the extent it has, and that basically means the percentage of their holdings in gold relative to other assets in most of that is being in bonds, has risen to the point where they may start to say, well, we don't need a big allocation into gold at this point in time, given the high valuations that we have on our gold portfolio or gold holdings. So that may slow, but I think underlying it will still be there. There are still central banks who has not been buying into gold, who may consider it as something they need to do in order to diversify. Asia remains a strong buyer, and especially in China. And as long as we don't see any bottoming out in the property market in China, which has now been a downturn for the last 4 years, and has been one of the major triggers for investors moving into alternative assets away from properties into gold and silver. As long as we don't see any recovery there, then the investors in China will be looking for alternatives. Stock market has not been performing that great either. So we need to see that change in China, and until it does, then demand for gold and silver, I'll say especially gold, will continue to remain strong. And then just to look across the world, asset managers are still under allocated in gold. Even 12 months ago, many asset managers had no gold in their holdings, in their portfolios. That was only until they start receiving phone calls from the investors asking how much gold do we have, and when the answer was zero, then that basically started to bring some changes. And I think that is still a process that is ongoing, and there's also one of the reasons why I believe stronger in gold than I do believe in silver at these levels, simply because gold is a monetary metal. It can go to 10,000, 20,000. It doesn't really matter. Silver cannot go much higher before industrial demand starts to be negatively impacted. And that basically means it's only investors that can then carry it forward. And there will be scrap coming back into the market. So I think the next rally, when we see that, I think will be gold driven once again, with silver potentially struggling if we start to get back to 100 and above 100.
Just on that note, before we talk about silver, will we have a scenario where retail investors from the West matter more than the Chinese buyers in the next couple of weeks? Right now, it's lunar holidays. And so for China, and Chinese-speaking regions, we have 10 days of no trading activity. What kind of data will you be looking for?
Well, that's a really good question and good point, David, because we have seen in the last 12 to 18 months that the East has been the demand from the East has become increasingly important. That the traditional investors in the West have kind of passed on the baton to investors in the East, especially in China. And now with those markets closed and also ahead of that, we saw this a lot of speculative frenzy both into gold and especially silver. Some of that was rolled back or scaled back ahead of this long holiday break. Who wants to carry risk when you can't get in or out for such an extended period of time? So the next week will be interesting to see how the metals perform. I think there could be a risk that we could be drifting lower, simply because we don't have that pull. But at the same time, when we get back in a week's time or so, and we get into early March, that's really when we need to. I think we should look to that period to get a feel for the true and underlying strength in the market. The next 2 weeks will probably be quite a bit of noise, because we simply don't have all actors operating in the market. So I'll probably be sitting on my hands a little bit here for the next week or so, till we at least get the Chinese investors back and see how they respond to whatever price level that they meet when they come back.
Let's talk about silver now. You wrote that there's a large short position in silver from the Chinese side. So take a look at what you wrote for Saxo Bank. Positioning matters again beyond seasonal effects. Growing attention is being paid to positioning dynamics in China's futures market. Recent reporting by Bloomberg has identified Zhongkai futures linked to veteran trader Bian Ximing as holding what appears to be the largest net short position in SHFE silver. The reported scale, equivalent to several hundred tons of silver, is notable in a market that is structurally small and prone to sharp price dislocations. You wrote this February 5th, right pretty much a day after the big silver drawdown. So let's talk about this short position. Is it still relevant 2 weeks later?
That's a good question, yes, I mentioned it because it was reported, and it's just interesting to see how this position, this kind of size, can be juggled around in a market which is relatively small. And I was actually from when I read that, I was actually mostly more worried about a squeeze to the upside, simply because once it became known, we saw that in nickel a couple of years ago, where there's a massive short that was basically caught by the exchange rating margins and so on. But so far we hasn't really seen any major impact. But I'm still a bit perplexed that if there is a position of a short this size, considering how the market's been behaving recently. But it just goes to show that there has been a lot of speculative interest coming into the market. This is one single big short, but against that, a major amount of small longs, all adding up to a major long that really helped drive silver to the extent it did back in January, to the point where basically it ran out of oxygen and ran out of runway, and it had to stop, and we had to see a correction. Well, because also simply at that point the plumbing broke, and I know there's a lot of physical only focused traders who hate the paper market and say we just need to kill the paper market so we can get a real price discovery. But I think I'm sorry to say, without the paper market, we don't have any discovery at all, because it is really the liquidity provided to the market, and a short in the futures market may be a long in the cash market, so you never really know exactly what the position is. But what we did note towards the end of January, and actually I sent out a warning to our clients on the Thursday morning when they started to correct in the afternoon. Timing wise, obviously that was not something I had envisaged at all. But I just sent out a warning simply because my traders were saying the plumbing is breaking apart. The plumbing doesn't work. Volatility is going up. Prices are going up. Banks are quoting less size to each other for physical, and that basically means we're into a situation where the risk of something breaking is really close. And we saw that as well with the significant amount of call buying going into the SLV ETF. as someone had to sell these calls, and those who sold the calls had to cover their delta by buying silver. And as these prices more or less moved into the money within very few trading days, because the rally was as strong as it was, these guys end up with a massive long delta that suddenly had to get unwind when the price is corrected, and into a market where there's no liquidity. So when the plumbing breaks, then we all have to worry, because then we may, if you're long, and you may enjoy the move, but the correction can be very, very violent, simply because liquidity disappears.
Yes, well, investors are also concerned about a potential squeeze on the COMEX. So COMEX registered silver dropping below 100 million ounces, according to this particular article. Official depository statistics from the COMEX, dated February 11th, confirms a major drawdown in silver stocks. The exchange reported a single-day negative adjustment of 3.2 million ounces in the registered category. As a result, total registered silver fell to 98 million ounces. That level is below the closely watched 100 million ounce threshold. You've written about this before. How likely is it that we do get a scenario in which the COMEX does not have enough silver to cover demand? In other words, a silver squeeze. Is this something that we should be watching for?
I think it's something we should be slightly worried about, but at the same time, it's not something that I think will happen, because ultimately we have to remember that the COMEX sets the rules, and if they need to change the rules in order to avoid it happening, then they will. Right now we are seeing open interest in the March contract coming down fairly hard. It did slow down a bit on Friday. There was not that big a reduction in the March open interest, and that clearly needs to come down quite significantly in the next couple of weeks. But we also have to remember that it's not on the actual first notice day that we look at it. The notice period runs for a whole month, so there's quite a lot of time for the both long and shorts to be reduced. So I'm not too concerned that it will happen, but there's no doubt that with the kind of interest we see in the silver market, and with the inventory levels, or the deliverable stockpile as low as it is, then the market will, if there's no problem in March, then the investors will look towards May and say, well, then it might be May when things happen. So we need to see inventory levels start to move up again. They have been moved to London in recent weeks, so there's been a draw in the COMEX market into the London market, which inadvertently has actually helped stabilize the market, because liquidity is returning to the physical market, and that's helping to bring some of the lease rates and the carry rates more under control. But it is something we need to watch, but at this point in time, I'm not too concerned. I think the open interest will continue to come down, and come down fast in the coming days.
Well, in your opinion, what was the major contributor to silver rising dramatically from $30, just $35 in September, to $50 shortly after, and then a straight line from $50 to $100 in a matter of 2 months? That may have, some people say that may have not been purely higher demand. It's not possible within a short amount of time if it's purely demand driven. It must have been a structural deficit, or perhaps a major shortage somewhere that drove this up. What do you think?
I think it was speculation about a major shortage that basically collectively helped drive a lot of small investors into the market. And if there's enough buying at the same time, in even though it's smaller amount, then it all adds up. And when you get this extreme amount of buying in the call options on some of the major ETFs, then the move starts. I think that actually when we moved up towards the $50, that at that point we did see some buying from industrialists, industrial users, simply because normally in normal markets, the best cure for high price is a high price, because it lowers demand. But at this point, when we at the same time talk about the potential deficit, there could have been some industrial demand, simply because they felt they had to buy it in order to ensure that they didn't run out of silver for the coming period. So I think that was part of the initial phase of the rally when we broke 50. But then the acceleration we saw when we moved above, that was simply a market where liquidity was starting to dry out, and that meaning it was a lot easier to push it. At the same time, you really want, and at the same time, I think there's also attempts to sell into it. which then got stopped out. And that's what we see when we have a bull market, that quite a lot of the time, quite a lot of the buying that takes it to new highs are shorts that got it wrong and need to get back in or get out of their shorts. So it was just a combination of many different things. We are seeing we still need to see what the impact on the demand side will be, but also the supply side, because so far this year, I saw the Silver Institute recently come out with a forecast. They're looking for a deficit of around 2,000 tons. Was it 2,000 tons? Well, I can't remember now. I can't remember the number, but
that's okay.
It was when we look at that obviously on paper looks pretty look like a high number, but we need to work out what kind of industrial demand destruction impact these higher prices will have. And I think it'll probably take time, because first of all, industrial users will pass on the increases to the consumer, and if they start to say, well, we're not going to pay these levels, then eventually production is going to be negatively impacted, and that could lead to a slowdown in industrial demand, much more than what we're seeing here.
Yeah. I mean,
and then at the same time, yeah, go on.
Oh, sorry. I was going to say, well, look, yes, we do know that the silver market has been in a deficit for quite some time, according to the Silver Institute. But the Silver Institute has been, has been publishing a deficit number for many years now. And what's taking people by surprise is the fact that this move happened this quickly, this suddenly. How would you explain that?
Simply, I have to call it a speculative frenzy, because we're all seeing and hearing the same things, and then not to look in different directions, but we've seen a bit of the squeeze mentality, and we saw with Bitcoin as well in the past 5 to 10 years, where groups basically they're all talking about some elusive numbers that we can reach. And obviously, if you start thinking, well, the silver can go to 1,000 and it's only trading at 80, of course you want to get involved. And so with that in mind, I think it's very healthy that we're just seeing a bit of a reality check now on prices, and just see it stabilizes. And if we move high again from here, well, then it does indicate that the underlying demand is still there, and then it's justified.
Well, can you make the argument that the deficit in supply-demand dynamics don't really matter all that much? Because like I said earlier, I've been noticing that Silver Institute has published a deficit number for many years already. This price has basically stayed flat up until last year, and then all of a sudden, due to a speculative frenzy, like you said, the price shot up. So it had nothing to do with the fact that all of a sudden it's been in a supply deficit. It's been in a supply deficit for years already, Ole.
Yeah, it has, and what probably helped trigger the focus on this deficit was the shipments of silver to New York ahead of or the threat of tariffs announced. We saw that in copper last year, and we also saw a lot of silver suddenly being shipped, and that helped create this tightness in the London market last August or October, I believe it was. And that's really when it kicked off in earnest. And that was the tightness in the physical market, because silver was being shipped to New York or to the US ahead of a potential tariff announcement. And that's really when the focus resurfaced. And then the speculative interest that basically takes over, and China has most certainly been a major part of this. You only have to look at some of the funds offered to Chinese investors. There's one that is the only pure silver fund is just a mind-blowing. Just on the Thursday before the Friday collapse in January, it traded at a 50% premium to the underlying value of the positions it held. So investors in China were prepared to pay 50% above the underlying value. That tells me that this is purely speculative, because if you just sat down and actually looked at what it is you're buying, would you pay 50% above an underlying price to get involved, hoping that someone else would pay 50% or higher, even higher tomorrow? That is the biggest sign that when you get into a frenzy where you have to be a bit careful. And the result of this was that the plumbing in this fund broke, and on a Friday the market was shut. and then it was basically limit down 4 days in a row, 10% every day, meaning you were just sitting there, you couldn't get out. So we need to watch very closely what happens in China. Silver inventories in Shanghai is also being depleted at this point in time. So we need to see supply come into the market from somewhere. Whether that's coming from scrap, that remains to be seen. But now kind of I've remembered the numbers well, because I was just reading a Danish paper at the weekend, and there's a Danish a shop basically buying and selling silver, mostly buying it, and they basically said that they have taken in between 4 and 5 tons of silver in the last 3 months. And if you look at the global deficit, I believe it's 2,000 tons. Then if 4 or 5 tons has come in just in Denmark, which is a country which is not known at all for its trading in precious metals, and you scale that up to the global space, then there will be scrap coming into the market in the next 3 to 4 months, and then we have to get at that point in time, I would have a better idea, a better view of whether this deficit is actually something we need to be concerned about.
And so finally on silver, before we move on and close off the conversation, on silver, you said that it may not rise as much as gold. You're more bullish on gold. So where does silver land for you end of the year? We're at $76 now.
Well, I think I prefer to look at silver as a relative play to gold. I mean, I know that a lot of people don't want they look at it as an individual metal, but I think if you look at the last 20, 30 years, the gold-silver ratio has been averaging around 70. I know that if you are really bullish on silver, you look way further back than that, where the ratio was perhaps as low as 20. But let's just focus on the last 30 years. The ratio has been around 70. We dropped down, I believe, as low as was a 45 or something recently. Now we're back into the 60s. So based on gold going back to say 6,000 within the next year, then I could see silver stabilize perhaps in the $100 region. But I'm well, as you can gather from this, I'm certainly not the $200 band that some are looking at. So 100, I think, is potentially as far as we can get.
You've been in the industry for many years. Did you anticipate yourself saying the sentence, I anticipate silver stabilizing around $100 by 2026?
No, not at all. I traded my first silver 25 years ago.
Yeah,
it was probably nearly 30 years ago for a hedge fund in London, and we traded gold back then at $300 and silver at less than 10. So what we have seen this year is most certainly phenomenal, and I think there's probably still some people that in the years from now, they'll look back and say, well, wow, look at that peak we had before the collapse. I don't think I think times now are different. I think we can manage to hold on to most of these gains, but we need to see probably first of all some consolidation. But yeah, it is a phenomenal level that we've seen.
Finally, on oil, the fact that it's been trending lower ever since 2022, down pretty much 50% from its 2022 highs. What does that signal to you about the economy?
Well, it's probably mostly the fact that that production has managed to keep up with demand. Demand has been rising. We haven't really had any down years, maybe except the recession around the brief recession around COVID times. But the demand has been going up and continues to go up. So what I would say we've been blessed with cheap oil and cheap energy, because oil in the 60s historically, inflation adjusted everything. It is such a cheap source of energy, and the question is really how long can that be maintained? For now, we have a situation where there's enough being produced, not only from OPEC but also from non-OPEC. Some worries just in the short term about geopolitical risks to supply, but generally the market is supplied, has got ample supply. But looking ahead, we still have to, if the projections are that demand will continue to rise, perhaps at a slower pace than what we've seen in the last 5 to 10 years. But if demand continues to rise, and we have the low-hanging fruits has been picked, so basically there's going to be depletion rates in the order of 6 to 8 million barrels on an annual basis. we need a lot of investment to go into the energy market in order to ensure we have that oil coming out of the ground. And I think at current prices is simply not high enough, because all these energy companies, they witnessed and experienced inflation as well. Labor costs, cost of metals, cost of their raw materials, and everything has been going up. So we need higher prices over time in order to in order to ensure that we have supplies. So I think the 60s, I think we should enjoy it while they last. If we talk again a couple of years from now, I would imagine that we're seeing oil trading at least up into the 80s, perhaps in the 90s.
How significant is the Middle East relative to oil? President Trump, over the past weekend has been advocating for a regime change in Iran, which is a 180-degree change in stance, by the way. A couple months ago in 2025, he said he's not supporting a regime change. Now he is vocally advocating for it. The battle group carrier has already been pulled back, so tensions are dying down a little bit. But if Iran falls to a different regime, does that play a role on the oil price?
Oh, it does indeed, absolutely, and that's really what makes it very difficult to predict, because one thing is wanting a regime change in a faraway country called Iran. Another thing is what that regime change would mean in the short term for consumers in the U.S. And I know it's a bit cynical to look at this way, but we are in a year where there's a midterm election coming up, and U.S. voters I'm sure they care more about domestic fuel prices than they care about what happens in Iran. So with that in mind, I struggle to see any action that could cause a disruption from the Middle East. But if that does happen, then we're not going to look at Brent, the global benchmark, trading below 70. Then we will spike above 70 for a period of time, because not only Iran supplies could be impacted, also in supplies from other states sending their crude through the Strait of Hormuz close to Iran. So the next couple of weeks will be extremely interesting to watch. But I just have to remain cynical at this point in time, saying, well, that it's not in the U.S. interest or at least in the president's interest, to cause gasoline prices to move higher. Also, we saw the CPI, the inflation print last week. One of the reasons why it was lower than expected was low energy prices. So at least that's one box that can be ticked in terms of what has been promised and delivered. So risking that, I think, is something that there really has to be some very strong arguments within the administration to go ahead and cause a disruption that causes higher prices.
Okay, excellent. Thank you very much, Ole. We appreciate your thoughts. Let's end the discussion here, and we'll follow up next time. Where can we follow your work?
Well, as you mentioned, I work at Saxo Bank here in Copenhagen. We are a global online bank. We have our websites where we post everything, so that can be found on home.saxo/insights. Otherwise, I post everything I do also on X and on Substack. My X is Ole _S_Hansen with an E. And that's where I post everything, besides what I post on the Saxo websites.
Okay, thank you very much. We'll put the links down below, so make sure to follow the Saxo website there. Appreciate you once more, Ole. Speak next time. Take care for now.
Thank you very much.
Thank you for watching. Don't forget to like and subscribe.